Since we're in an election year, I thought that it would be a great time to discuss how markets have historically moved during election years. I'm also going to share some things to keep in mind as the election unfolds. The market seems to follow somewhat of the same pattern during election years. We often see an increased level of volatility during the first 6 months of the year and then positive growth towards the second half of the year. I think that this has to do with uncertainty. The market's forward-looking and it doesn't like uncertainty. And I think that the switch from an increased level of volatility to positive trajectory may have something to do with the Democratic and Republican national conventions. After these conventions, each party has now officially put their candidate forward, which leads to more clarity around who will end up on the ballot and ultimately who might end up in the White House. Less uncertainty leads to less volatility. This election year is a little different than some of the previous ones because both of the likely candidates at this point in time have been president before. The market has already been able to see their policies in action, and questions like what is their view on taxes, how pro-business are they, have already been answered. We prefer to leave the politics to someone else, but when speaking purely about the stock market, we feel optimistic because the market's been able to perform well under both of these administrations. In fact, the market's been able to perform well whether a Democrat or Republican wins the presidential election. From 1928 to 2020, the average return of the S&P 500 in all election years was 11.58%. Now you may be thinking, this is great, but what should I be doing this year? And here's a few actionable things that you should keep in mind throughout the year. It's essential to maintain a long-term perspective when it comes to investing, especially during times of heightened uncertainty. Economic fundamentals and corporate earnings tend to drive long-term market performance much more than short-term political events. Diversification remains a fundamental principle of investing. By spreading your investments across different asset classes, you can help mitigate the impact of any potential market volatility associated with election-related news. Resist the temptation to make significant changes to your investment strategy based solely on election-related news or predictions. Emotional reactions to short-term events can often lead to poor investment decisions. While election years can introduce uncertainty into the markets, staying disciplined, diversified, and focused on the long term can help investors navigate through any potential volatility. If you have any questions or concerns about your investment strategy during this election year, don't hesitate to reach out to us. Thanks for watching, and until next time, happy investing.